Welcome back to class as promised. We are starting from where we stopped in our last class, and here we are starting with the registration of companies for tax purpose. Okay, so companies are required to register for tax and file their audited accounts as well as tax computations, which must include the computation of income tax and then capital allowances with the Federal Inland Revenue Service within 6 months. Okay, within 6 months of their financial statements, within 6 months of their financial, let me put it as financial year end. So in Nigeria we practice different type of assessments. Okay, so but the most popular one is the self assessment. That is, the tax law allows taxpayer to assess themselves, okay, based on what they feel is appropriate. Okay, so on self-assessment basis or 18 months after incorporation, or 18 months after incorporation, so whichever comes first. Okay, so a company may file an application for extension of filing tax returns for up to 2 months at the discretion of the FIRS. So the company must file the following documents. The company must file the following documents with the tax authority for the purposes of obtaining the company tax identification number. For the purpose of obtaining the company's tax identification number. So one, you have copy of the certificate of registration, that is your CAC document, including your memorandum of association. Okay, so we have a copy of the certificate of registration, your CAC certificate, copy of the memorandum and copy of the memorandum and article of association. Copy of your memorandum and article of association. You have copy of the particulars of return, of allotments, copies of particulars of returns of allotments of shares, that's a form CAC 2.5, and then D, copy of the particulars of first directors, from CAC 2.3. okay, so upon registration of a company as a taxpayer, so the FIRS issue a tax identification number, which serves as the company's file number for all federal taxes and future correspondence with the Federal Inland Revenue Service. So the company must file okay, so annually, on an annual basis, the company must file with the tax authority. The company must file with the tax authority, as mentioned earlier, their tax computation for the relevant year of assessment, and then 2, the audited financial statements for the respective the financial statement for the respective period. Okay, and this should be in conformity, the financial statements for the respective period in line or in conformity with the requirements of the International Financial Reporting Standards. And then 3, a duly completed and then signed self-assessment form for companies' income tax. Okay, and don't forget that since the adoption of the tax promise, okay, so tax offices no longer collect physical copies of your tax computation and then audited financial statements. Okay, so you'll be going there with the evidence of payments, if any, okay, and as well as the evidence of online filing and the completed and signed self-assessment form. Okay, so we have evidence of the income tax liability either in part or in full. Okay, either in part or in full. So in line with the section 8 subsection 1 of the Evaluators Tax Act, which says that taxable person shall within 6 months of the commencement of the Value-Added Tax Act or within 6 months of the commencement of business of a company, whichever is earlier, register with the Federal Inland Revenue Service Board for the purposes of tax. Okay, so section 8 subsection 2 of the Evaluators Tax Act says, without prejudice to the provisions of section 32 of the Evaluators Tax Act, a taxable person who fails or refuses to register with the board within the stipulated time in section 8 subsection 1 of these acts as amended shall be liable to pay as penalty an amount of 50,000 naira for the first month in which the failure occurs, and then 25,000 naira for each subsequent month in which the failure continues. This is in line with the Finance Act of 2019. Okay, so Finance Act of 2019 amends this section of the Evaluators Tax Act. Okay, so though before the Finance Act of 2019, the penalty used to be 10,000 naira for the first month in which the failure occurs, and then 5,000 naira for each subsequent month in which the failure continues. But since the signing of the Finance Act, okay, which became effective on 1st February 2020, okay, so failure to register for VAT, failure to file VAT returns, okay, attracts penalty in the first instance 50,000 naira, and subsequently that is 25,000 naira for every month of which the failure continues. Okay, so that's registration of companies. Now any government, parastatal agencies or departments are also to read. All government agencies, parastatals or departments are equally to register. Okay, they are also to register by they are also to register with the Federal Inland Revenue Service for tax purposes. Okay, so registration by government ministries, departments, that's MDAs, departments, okay, etc, as what, as agents of the board, do you understand? So this is in line with section 9. This is in line with section 9 subsection 1 of the Value Added Tax Act, okay, which says that every government ministry, statutory body, and other agency of the government shall register as agents of the board for the purpose of collection of tax under this act. Why section 2, okay, so this is on registration, and then we have section 9 subsection 2 of the Value Added Tax Act, which says that every contractor transacting business with a government ministry, statutory body, and other agents of the federal, state, or local government shall produce evidence of registration. With the board, that is evidence of registration with the FIRS, okay, as a condition for obtaining contracts. Okay, so these are like setting a condition for every companies, corporate organization, for every contractor transacting business with the government ministry, parastatals, agency, statutory body, states, of the federal or states and local government. Okay, so that's that. Now let's look at registration by non-resident companies. Okay, does non-resident company has to register with the Federal Inland Revenue Service, knowing fully that they were not registered under the corporate affairs. They are not registered with the Corporate Affairs Commissions of Nigeria. Okay, so yeah, you see, section 10 subsection 1 of the Value Added Tax Act says a non-resident company that carries on business in Nigeria shall register for the tax with the board, okay, using the address of the person with whom it has a subsisting contract as its address for the purpose of correspondence relating to the tax. While section 10 subsection 2 of the Value Added Tax Act, says a non-resident company shall include the tax in its invoice and the person to whom the goods or services are supplied, and the persons to whom the goods and services are supplied, okay, in Nigeria shall remit. The persons to whom the goods are supplied to in Nigeria shall remit the tax in the currency of transaction. So note that this section was amended through the Finance Act of 2020. Okay, and then it requires non-resident companies that make taxable supply of goods and services to Nigeria to register with the FIRS. Unlike what we used to have, where it is the supplier, okay, that remit the tax in the currency of transaction. Okay, so now the NRC, that is non-resident companies, are now charged to register directly for tax purpose with the FIRS. So now they will be having their TIN numbers. Okay, so when they obtain TIN, and then for all their invoices, the TIN is expected to appear on all their invoices. So while the resident, that is the resident company, shall be told and remit the value added tax to the FIRS in the currency of transaction, The non-resident companies may also appoint local representatives, probably tax consultants, to help them with their tax compliance obligation. Okay, so section 10 subsection 5 concludes the section by stating that the FIRS may issue a guideline for the purpose of giving effect to the provisions of this section. Okay, presumably such guideline, if and when issued, will not be an attempt to vary the statutory provisions, as such would clearly be ultra vires. Okay, so regarding the section 10 subsection 2, okay, so the Finance Act amends this section, and it authorizes the Federal Inland Revenue Service to direct operators in the oil and gas sector to deduct and remit VAT directly to the FIRS. Okay, so these to the FIRS has now been repeated. Okay, so before the VAT deduction at source, that is section 10 subsection 20, which states that the non-resident company shall include the tax in its invoice, and the person to whom the goods or services are supplied in Nigeria shall remit the tax in the currency of transaction. Okay, so this is for non-resident company. Okay, so now let's move to types of assessments. So we have more than 4 types of assessments. Okay, so we have 1, government assessment. 2, we have the turnover basis. We have the turnover basis of assessments. We have the turnover basis of assessments, and I also have the best of judgment. We have the best of judgments assessment. We have the best of judgments, otherwise known as BOJ assessments. We have the self assessment, and then we have the dividend basis. Okay, we have additional assessments. We have additional assessments. I have dividend basis of assessment. Okay, so under this, so now let's take them one after the other. Under government assessment, it is an assessment raised by the tax authority on taxpayer, either on the account submitted or at the discretion of the relevant tax authority, probably through best of judgment. Okay, so let's look at the turnover basis. You see, in line with the section 55 of the Companies Income Tax Act. Okay, so non-resident companies had previously been assessed to tax on the basis of their turnover. Okay, they have previously been assessed on the basis of their turnover. Okay, so instead of actual profit. This is based on the provisions of section 30. It is based on the provisions of section 30 of Citn, which empowers the FIRS to assess a company to tax based on its turnover, where it appears that in a particular year of assessment it has no assessable profits or assessable profits which are less than might be expected to arise from the trade or business, or where the true amount of the assessable profits cannot be ascertained. So 3 conditions. So is either the company does not have an assessable profit, or the assessable profit it has is less than what is expected from that trade or business, or where the true amount of the assessable profit cannot be ascertained. So under the FIRS guidelines, the non-resident company is then taxed on the higher of actual or deemed profits. On the higher of actual or deemed profits, invariably the deemed profit produces higher tax, and this is referred to as the turnover or deemed income basis of assessment. So in arriving at the tax payable by a non-resident company using the turnover basis, okay, so the practice is or the common practice is 20% of the turnover, which is usually treated as the deemed profit, which is then taxed at the corporate tax rate, depending on the category of companies. Don't forget that the Finance Act of 2019 categorized or classified companies into 3. We have the small companies with turnover of 25 million and below, and the applicable tax rate is 0%. And we have the medium-sized companies, which are companies with turnover of between 100 million and then 25 million naira, and then and their tax rate is at 20%. And then lastly, we have the large companies, which are companies with turnover of above 100 million naira, and the applicable tax rate is 30%. Okay, so this resulting in an effective tax rate of 6%, 4%. Okay, so this rate has been in operation since 1996, when the then Minister of Finance, on behalf of the federal government of Nigeria, announced at the 1996 budget press briefing that effective tax rate for NRC will be 6% of turnover. So that was what we have until recently, when we start having the Finance Act. Okay, so the Finance Act of 2020 amends the Section 55 of the Companies Income Tax Act. Okay, so the Section 55 of the Companies Income Tax Act now mandates non-resident companies deriving profits from Nigeria, okay, to file their actual accounts, effectively doing away with deemed profit basis of assessment that the FIRS normally utilize whenever non-resident companies failed or we are unwilling for whatever reason to submit actual data to Nigerian operations. So by virtue of this new section Section 55, subsection 1A of Citn, such NRCs, that is non-resident companies, are required to submit with their tax returns a company's full audited financial statement and the financial statement of the Nigerian operations. So you submit both the foreign audited financial statements and that of its subsidiary or its local operations. Are we together? So, and this must be attested to by an independent, qualified or certified accountant in Nigeria. The tax computation schedules based on the profit attributable to its Nigerian operations, a true and correct statement in writing containing the amount of profits from each and every source in Nigeria, and then duly completed company's income tax assessment forms. Okay, so just like a resident company, okay, so non-resident companies are also to file their returns with the listed documents attached to the to a cover letter for submission of the returns. Okay, so now we have let's move to the self-assessment. Now, I mentioned earlier that in Nigeria we are practicing our self-assessment. We are practicing our self-assessment. Okay, so companies in Nigeria, okay, as you all know, if you are in employment, file their tax returns based on a self-assessment system where the taxpayer prepares its annual returns and determines its tax liability. The reason for this is because they believe it is the taxpayer that are in business and they should be able to determine without compromise, okay, to determine the appropriate tax to pay, that is without biasness, okay, without being biased. Okay, so yes, this should be done within 6 months. That is, the self-assessment should be filed within 6 months after the accounting year end, and the company can apply to the FIRS in writing to pay its income tax in installments. So the maximum number of installments the FIRS may approve is 3. Okay, so evidence of the first installment has to accompany the tax returns filed in order to qualify for the installment payment. However, all payments have to be made not later than 8 months after the financial year end. Assessments are also to be made on a preceding year basis. In fact, the Finance Act of 2019, okay, so now makes it uniform for every company, be it at commencement or cessation. Okay, so basically a subsisting company should file returns on preceding year basis. So this Finance Act of 2019 has eliminated or abolished the issues surrounding overlapping and gapping in the basis period. Okay, in our basis period. So going forward, we won't be having issues on our basis period for the preparation of our tax returns. Okay, so that's that. Now, one of the advantages of self-assessment is that taxpayer is entitled to 1% bonus of tax payable, that is for early payments. Okay, for early payments, probably within the first 2 months of the months following the accounting year end. Okay, so 1% for large companies and 2% for medium-sized companies. Okay, so if you can file within the first 2 or 3 months after the company's year end. So also, self-assessment files are exempted from payment of provisional tax, though this has been abolished by the through the Finance Act of 2019. So there's nothing like provisional tax any longer. So we also have self-assessment files. Self-assessment filers are entitled, that is that the taxpayers are entitled to or may apply for instrumental payment of the tax liability. Okay, so and we move to additional assessment. If FIS discovers or is of the opinion that income has not been assessed or has been under assessed, or that excessive relief has been given, an assessment or an additional assessment can be made. And assessment or additional assessment cannot be made later than 6 years from the end of the year to which it relates, so except in cases of fraud, willful defaults, or neglect, where there is no time limit within which any assessment can be made. So penalty for non-compliance: failure to comply with the requirements of the Companies Income Tax Act on the return filing, okay, for companies income tax within 6 months after the end of the financial year, attract a penalty of 25,000 naira for the first month and then 5,000 naira for each of for each of the subsequent month of default. So late penalty or late payment of CIT attracts a 10% penalty and interest at the commercial rate, and interest at the commercial rates. Are we together? So let's go on break. When we come back, we shall continue from where we stopped. Thank you.